90.3 WHPC now presents Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now, learn about the law and how to protect yourself against the loss of your liberty or property, and learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau, a past dean of the Nassau Academy of Law, and frequently lectures to lawyers on ethics and avoiding problems with clients, and to the public on how to choose and use lawyers. This is Law You Should Know on the voice of Nassau Community College, 90.3 WHPC.
Hi, this is Ken Landau, and welcome to Law You Should Know. Today we're going to discuss sales tax issues, and our guest is Mark L. Stone. He's a CPA, and he is the head of Sales Tax Defense, LLC. He is not a lawyer, but he, as you've heard, is a CPA, and he specializes in these issues and helping businesses to avoid trouble. And, of course, we're going to talk about when consumers have to pay sales tax and what sales tax is all about. Mark, welcome to Law You Should Know.
Ken, thank you for having me here. I'm excited to have the opportunity.
Okay. We all know about sales tax. It's part of our lives, and most people don't like it. But what is the idea behind sales tax?
Well, it's basically a gross receipts tax that when you go into a store and the state has said certain things are taxable, they collect a percentage or an additional percentage of revenue on top of whatever you're paying. We're probably most familiar with it in a restaurant. You go in and you get dinner for $100, and they charge you sales tax on top of dinner, so you know it's another $8 or $9 of sales tax. And everybody does, the basic thing. All right, I got to leave a tip for the waiter or waitress, and I double the tax after that. But that first $8 or $9 is money that goes directly to Albany, and the state government spends it.
Now, what if a consumer, is trying to save a few bucks and says to the restaurant, look, I'm going to pay you in cash. I'm not going to use a credit card, and I just want you to take off the tax. The consumer is not really doing anything wrong. They're negotiating a little discount.
So interesting. You said it two different ways. So one thing is very illegal and one thing is very legal.
Sure.
So a couple of pieces. If anyone ever looked at what the law says, it's called sales and use, USE, use tax. So what it basically says is that if a retailer, the restaurant, doesn't charge you sales tax, you as the purchaser still owe that tax as a use tax directly to Albany. So it's a crime to actually say, I'll pay you cash, don't charge me the tax. What you could say to a restaurant is, I'll pay you cash, give me an 8% discount, and then still charge me the tax. And then, of course, the restaurant is eating that $8 discount, not Albany.
And who has to prove the tax was paid? Is it the business has to, because the business has the obligation to withhold the tax, to collect it and segregate it.
So most people in America have this perception that you're innocent until proven guilty. That's actually very false and very wrong when it comes to taxes. So the burden to show that you paid a tax, the burden to show that tax is not due on a transaction, falls on the business and falls on the consumer. And there's actually a very simple reason for that. If the burden was the other way around, every business that ever got audited would say that they had a flood, they have no records, the government would never be able to prove they did anything wrong, and then there would never be any tax assessments, and they wouldn't be able to enforce the system. So the presumption is that the government is right until the business is wrong. And of course, when the government makes an estimated assessment, they always guess very, very, very high numbers.
But a consumer is not usually going to keep records of proving that they paid sales tax on something. It's sort of the business that's going to keep records showing what they sold and they collected the appropriate sales tax.
Yes, that's definitely true. But New York State has a couple of systems in place to go after consumers, to go after individuals. The first thing they do is at airports, when you declare something for customs, if you fly into one of the New York airports, Albany again gets that list of whatever you declared, and about 18 months later, they automatically send you a bill for the sales tax on whatever you brought into the country, whatever you brought into New York, because the presumption is if you're bringing something in from Europe or Asia or wherever you're coming back from, that you didn't pay New York sales tax on it.
And is there a minimum, or if you spend $10 on something,
$10, they want 80 cents.
Okay.
Do you know what they also do, which is interesting, that we're coming up, it's not that far away. Winter's almost over. Summer's going to be here. They actually have agents that walk around all of the marinas on Long Island, and take down all the hull numbers of all the ships and cross-reference it against DMV. And for everybody that brought their boat back from Florida, if you haven't paid New York sales tax on it, they send you a bill for sales tax on your boat also.
And now, if you live in another state, do they have trouble going after you, or states? There's certain reciprocity among states?
As an individual, if you live in another state and you don't have a house or an apartment or a place where you can live in New York as well, they're not really allowed to go after you for sales tax. It's the state that you're domiciled in, the state where you reside, the state where you have a house, that you have to worry about sales tax. If you're just passing through, other than when you buy something here, you pay the sales tax when you pick it up, but other than that, they won't chase you.
So you can get a discount in buying something or buying something major, but you have to prove that you paid the sales tax. You can't just say eliminate the tax. You're asking for an 8% discount on the goods and then adding the sales tax back in.
Absolutely correct. And on any invoice they give you, sales tax always has to be a separately stated line item on that bill.
People are doing home improvements, or maybe they're building house and buying materials for it. Are there certain materials that are exempt from sales tax?
Not really materials, but what New York does, it breaks all construction work into one of two categories. It can't be anything other than one of these two categories. One category is called a capital improvement, which is more of a bigger renovation that adds value to your home. It's some sort of permanent improvement to the house. And the opposite is repair and maintenance work. Repair and maintenance work is just restoring something to its original working condition. What New York says with sales tax is that when you do a capital improvement, whomever goes to the store or the supply house or the vendor and buys the materials pays the sales tax on the materials, but there's no sales tax on the labor. So, I mean, very often what the scenario is the contractor goes and picks up whatever materials they need. They would pay the sales tax on the materials that they buy, and then they just charge you a lump sum for that project. On a repair and maintenance job, you don't really have to pay the tax when you buy the materials. Rather, the contractor that does the work is supposed to charge you sales tax on both the labor and the materials.
And that contractor is responsible paying it on the materials and the labor, even if they got the materials from someone else?
The contractor is responsible on a capital improvement for paying the tax on the materials. On a repair and maintenance job, the homeowner, the consumer, is responsible for just paying tax on the entire selling price that the contractor charges them for that work.
And so there's no part of it that's exempt. If it's some permanent part of the house, or it's like a deck, something physically that becomes a permanent part of the house, that's still subject to sales tax.
The materials are still subject to sales tax.
Oh, but not the labor.
Correct.
Okay. And what are some of the other issues that small business owners have to worry about in terms of collecting sales tax or sending it on to the proper authority?
The biggest issue facing everyone today now is multi-state sales tax. Until about 5-6 years ago, the law in the country was that if you were located in one state and shipped everything out to other states, you didn't have to charge sales tax to all the other states. You only had to worry about charging sales tax in your home state. And for example, in New York, as probably a lot of us know, Nassau and Suffolk County have one sales tax rate, and Queens and the other city boroughs have a different sales tax rate. And we know that because we live here. But if we were selling something to California, California has the same kind of setup with counties and cities that we have. They have lots of different sales tax rates too. How do we figure that out? So until 2018, it was never an issue. Unfortunately, in 2018, the Supreme Court reversed a decades-old decision and said that even if you're not located in a state, if you're doing more than $100,000 of business into that state, if you're doing more than 200 transactions in that state, you need to follow that state's rules as if you had an office there. And that generally means collect sales tax, obviously file sales tax returns, and remit the sales tax. So now you have these, I'm going to call them mom and pop businesses that are doing, which is not a crazy number, $1 million or $2 million a year in sales. And that may be among 5 or 6 different states. And now all of a sudden they have an obligation to file sales tax in not only New York, but New Jersey, Connecticut, Pennsylvania, California, Texas, Florida. And people don't really have any idea how to do that, what's taxable, what sales tax rate to charge, how to do the forms. it's really a pretty onerous burden that the Supreme Court inadvertently put on all these small businesses.
Now, that in turn has created more work for you.
Fortunately, yes, it has.
Right. So how do you help businesses carry out their responsibilities, after the sale and down the road in case there's a problem?
So we work with a lot of businesses that have to file multi-state sales tax returns, and we get the information from them, what their sales are, where they sold things, and we have software, and we run it through our software, and then we prepare the sales tax returns in all the different states, electronically file those sales tax returns, and then the states, and this is really something important to point out for a lot of people, the states directly debit their checking accounts for the money, and that's how they pay the taxes. What you generally don't want, with something that I'm on the most part opposed to, you don't want to be sending me a check for your taxes and having me cash your check and then send my own check for your taxes. That's how a lot of businesses along the way get scammed by unscrupulous tax preparers. It really should be the government directly pulling the money out of your account for safety purposes.
And just like with income tax.
Exactly. The IRS directly debits your account. You don't write your accountant a check for the taxes and have him rewrite a check. So you just have to be a little careful with that in most circumstances.
What kind of issues sometimes, hopefully a company hired you to handle these sales tax filings and you took care of them and they wrote their check. But what kind of issues come back to haunt these companies that you work for, and how do you help them in those situations?
So we do a lot of, I would call it, mitigation work, where people have gotten a letter from the government and the government says you didn't pay the right amount, or we're coming to check your books to see if you did pay the right amount. And it's usually referred to us from other accountants. And the problem there, of course, is people, unfortunately, are very reactive. The government's knocking on my door. What do I do? And the right answer is 3 years before they knock on your door, you should say, what do I do? Because they're checking what you did, and we can't really change what you did. But things that we see that are very common mistakes. A lot of things, we work with a lot of software companies, believe it or not. In New York State, software and information services and protective and detective services are all subject to sales tax. And a lot of people think, well, I'm not getting anything tangible. I'm not getting a product. I'm not getting something I can hold or touch. So why should I pay sales tax on that? But New York State arbitrarily has said these services, among other services, are subject to sales tax. You don't like it? Too bad. So a lot of businesses get beat, and what happens is the government comes in and audits that business and says, oh, you're selling software? You should have been charging sales tax. Oh, you're selling an app? You should have been charging sales tax. Oh, you're providing SaaS services, software as a service that's on a cloud platform? You should have been charging sales tax. And they're not. And then the government issues a big bill to them for back sales tax, and they're stuck paying the sales tax that they really should have collected from their customers, because it's not realistic to go back to your customers from 2 or 3 years ago and say, you owe me $8, you owe me $80 of sales tax on that transaction from 2021. A lot of people are not going to pay that.
And if they own the business in the form of a corporation, are they personally liable for the sales tax?
So 2 pieces that the shareholders of a corporation are not personally liable, but the officers, the people that are signing checks, the people that are signing the tax returns at a corporation are personally liable.
And if they're on the corporate books as an officer?
Depending on what their responsibilities are, then they're personally liable. And a sales tax debt is not dischargeable in bankruptcy, so it doesn't go away even if the company is not able to pay it. And also an important fact for everybody to know, in New York, a lot of small businesses are not corporations anymore. A lot of them are LLCs, limited liability companies. Being a member of an LLC, regardless of what you do at the company or don't do at the company, does make you personally liable for any unpaid sales tax by that company. So LLCs are a bad structure to own an entity that might have sales tax problems.
And for those people, they're better off as let's say a corporation, because they may be in a situation when they're not responsible?
Yes, I think an S corporation, generally speaking, is better than an LLC for an active operating company.
How far do they have to keep their records of, let's say, the sales tax?
The law makes a minimum requirement of 3 years. I strongly recommend to people that they keep 7 years worth of records.
I want to remind our listeners we're talking about sales tax, what retailers and what customers need to know to protect themselves. Our guest is Mark Stone. He's a CPA, and he's the head of sales tax defense with offices in Deer Park. And as you've heard, they help businesses to prevent and respond to sales tax issues. Should someone who's selling something, at step one, do they obtain some kind of sales tax ID number?
Yes. Well, your approach if you own a business should actually start, I need to charge sales tax. And if I don't want to charge sales tax, then it should be why. That's where you should start from. And then assuming that you do need to charge sales tax, like most tax filings, there's an application that you do to the state government. They review to see whether you owe back taxes. If you don't owe back taxes, then they'll give you a certificate that allows you to collect tax. If you do owe back taxes, they won't allow you to even be a sales tax vendor until you clean up your old tax problem.
And does that sales tax number allow you to buy goods, let's say wholesale, without paying the sales tax at that point?
Yes, it does. And that term is actually resale. So you're allowed to then issue a resale certificate to your supplier, which is why your supplier then doesn't have to charge you sales tax.
Right. Otherwise, there would be double taxation. You'd have to pay the tax when you got the goods, and you'd have to pay the tax again?
Correct.
What are some of the big issues you see coming up in the future concerning sales tax?
You know, people, they talk about, the government uses, I forget the exact term, but the amount of tax that's lost because people are cheating in their taxes, not reporting things on their taxes. And the government gets an awful lot of third-party information. They talk about Big Brother is watching, and I'm not a paranoid person, but New York State gets information from the IRS. So New York State does, for every single business in New York State, match the 4 quarters of sales tax returns against that business's federal income tax returns. And when the sales in the federal income tax return is higher than the 4 quarters of sales tax returns, they send you a letter and say why. And if you can't explain why, they send you a bill for the difference. They do that with 1099K reporting, which is credit card reporting. They get information from insurance companies, from franchisors, from distributors. So there's a really big effort on the government's part to do information farming, to get what they think the right numbers should be, compare that to the actual numbers, and then send bills out for the difference. And they have less and less manpower, so they're doing this more and more with computers and more just automated. One computer says the number's 100, another computer says it's 90, they do 100 minus 90, and they send you a bill for $10 because that's just what the math in the computer said. And then you have to straighten it out.
And does the flip side work as well? If you don't show much income, you're not reporting much income, but you're buying lots of things, do they wonder how you have the money to buy all these things, to improve your house, buy a fancy car or anything like that? So
surprisingly, to the best of my knowledge so far, they have not been able to integrate, which they should be able to, DMV records with property tax records with income reporting. Because you would think that somebody that's driving 2 Mercedes and a BMW and paying $40,000 a year in property taxes should be showing more than...
As well as a mortgage.
Right. Should be showing more than $30,000 a year in income. But until it gets assigned to a human being and the human being looks at that, they're not quite there yet, but I think that's coming soon.
And does the IRS or the state tax agency pay bounty to whistleblowers if someone reports that discrepancy one way or the other?
So a couple of things on this. So the first thing that people should know is if the IRS makes a change to your income taxes, they do report that to New York State. New York State does not report up to the IRS. But the IRS does actually pay certain things for whistleblowers, is really what the term is. New York State does not do a similar kind of thing. However, in very big cases, the law in New York State says you can actually bring a lawsuit against someone on behalf of the state if they're cheating on their taxes and you know about it, and you're allowed to sue them for triple damages, and then you do get to keep a piece of it, and then the state gets the rest of it.
Now, are the lawyers who are willing to accept those cases on a contingency fee, or?
I've seen a few big cases. I don't know what the billing structure was for those law firms that took those cases and sued some very big companies. And it doesn't have to be an intentional error in their tax reporting. It just has to be an error in their tax reporting.
And you said companies. Does that apply to individuals?
It does apply to individuals, yes.
So if you really wanted to get back at a neighbor and you thought, based on the facts or their lifestyle, they weren't reporting, that's one way to do it.
It is, but how would you know what your neighbor's actually reporting on their income tax return?
What if you just randomly sent in a lot of possibilities, showing their house, their car? Again, I don't know how much information, if it's a general lead.
Well, I don't think they would follow up on a lead that said, my neighbor has 3 nice cars and a pool and just redid his house. I think he's cheating on his taxes. I think a better lead for them to follow up on would be, I walked into this store and they said, well, if you pay me in cash, I don't have to charge you tax then, because that shows that they're cheating the government out of sales tax. That they're more likely to try to send an investigator out and do the same thing, walk into the store, make a purchase, and then if they catch the store doing the wrong thing, trigger an audit and then assess them on what they perceive the deficiency to be.
Would you just like to remind our audience that we're talking with Mark Stone. He's a CPA and he's the head of sales tax defense. As he's been explaining, there are a lot of issues concerning sales tax, who has to pay them and who has to collect them. And if people don't, it leads to all kinds of financial and maybe even criminal jeopardy. If you missed any portion of the show or you want to tell someone else about it, just listen to the podcast at nccradio.org. And Marcus, what is your website in case a consumer or someone or a business wants to find out more about your organization? And I assume there's information about sales tax as well on your website?
Absolutely. The name of my firm is Sales Tax Defense, and our website is www.salestaxdefense.com. No spaces, no dashes, just Sales Tax Defense.
And again, just reiterating, your company, your CPA and your company just focuses on the sales tax issues, different than most accountants and most lawyers.
Correct. The way I try to actually explain it to people is that you probably have a family practitioner doctor, and there's a number of specialists in his Rolodex for when you have a heart problem, when you have a brain problem, when you have a toe problem. We're one of those phone numbers in your accountant's Rolodex.
Or computer if they don't have a Rolodex.
Yes, it's really a V card now in Microsoft right. Outlook. But exactly, I guess dating myself there. But as far as we help them help their clients with the sales tax problem, and again, it's not just New York State, it's multi-state.
And you also help them with the filings to prevent a problem. Make sure they're doing what is required, whether it's an individual who has to collect sales tax for their business or practice or a company.
Absolutely. And when I'm given the chance to do something proactively, it's much better than, unfortunately, having to do something reactively that the government's there handing someone a bill for $100,000.
And are there penalties if sales tax is not paid or overdue?
Always penalties on any late filing taxes. 30% of the tax, and New York State on top of that charges 14.5% interest compounded daily.
And if they're trying to do it on time and properly, there are sales tax forms that are filed quarterly or annually?
Monthly or quarterly generally.
Depending on the size of the business?
Correct.
And some people might be able to do them themselves. The important thing is they file the forms.
File and pay, yes.
File and pay, okay. What do you see as some big upcoming issues in terms of sales tax or sales tax enforcement?
Again, I mentioned the matching. That's a very big thing. Another big problem is just understanding the tax law. What should I be charging tax on? What shouldn't I be charging tax on? Lots of confusing areas, and states are not consistent from one area to another. In New York, with food, people don't even understand the rules. And
I was just going to mention that. And once I recall being in a supermarket and getting charged sales tax when maybe it wasn't appropriate. If someone's at the supermarket, what are some things that are taxable and some things are not non-taxable, especially which might surprise consumers?
So the underlying concept is that necessities for food are supposed to be non-taxable and luxury items are supposed to be taxable. The way that actually works in a supermarket, if you go and you buy cold cuts from the deli counter by the pound, that's not taxable because that's a necessity. But if you're lazy and you ask the deli to make you a sandwich with cold cuts, that is taxable because that's a luxury item because someone made a sandwich for you. You go into a supermarket and you buy milk or juice, that's not taxable because that's a necessity. But you buy soda or bottled water, that's a luxury item that you pay tax on. Because if you don't want water to be a luxury item, drink it out of the tap like we used to do 30 years ago.
And what if the food is cooked? You buy it, it's cooked chicken or fish or whatever, even if it's not hot. Is that, you buying at a supermarket, is that a different category of food?
So food that's sold hot, that they're trying to keep hot, is taxable.
So if you buy it at a buffet table or from a hot buffet, it's taxable.
Correct.
If it's at the deli counter and it's cooked and it's cold, there's no tax.
Correct. Or if it's cooked and it's warm, but it just came out of the oven, which is why it's warm, specifically bagels, bakery items, things like that, but they're not keeping it under a heat lamp, that's also not taxable. But if they're trying to keep it warm, that is taxable, and the courts have defined warm as 2 degrees above room temperature.
So that microwave incurs tax liability. If they
microwave it for you, yes.
Or if they heat up the coffee. So hot coffee is taxed?
Always taxable, yes, because it's hot.
But if it's cold coffee, it's no tax.
So if it's cold coffee in a cup that they closed, it's taxable. If it's cold coffee that's sold in a supermarket state, if you think of in the front of a supermarket, they have the refrigerators, and in the refrigerators are either iced tea or Starbucks mochaccino to go. Those items are not subject to sales tax because they're sealed.
And if you bring your own cup to Starbucks, what happens?
Starbucks is always going to charge a tax.
Are they supposed to, though, if it's your own cup? Because it's hot?
Yes.
Mark, just give your website again.
Again, it's www.salestaxdefense.com.
And I would like to thank Mark Stone of Sales Tax Defense with offices in Deer Park for being a guest on Law You Should Know and explaining some of the intricacies of to tax or not to tax. And, of course, if it's being taxed, the retailer has to forward it. If a consumer, are there any other issues with the supermarket, that surprising things about what's taxed and what's not, so a consumer can be aware if they're properly getting taxed?
There's different categories. Like I was saying, bakery items are not taxable. Cold frozen food is generally not taxable. But things that are candy, confectionery, those things are taxable. Things that are not healthy for you.
A pie would, or what if it's a muffin they made in the store?
Funny rules, but
and it's cold.
Muffins are bakery items and not taxable. Ice cream cakes are not taxable. Hand-packed ice cream is not taxable, but ice cream sundaes are taxable. I mean, there's some weird things with that.
Okay, but it's good to know that you're an expert on all the ice cream and all the toppings, what's taxable and what's not. And again, Mark's website is salestaxdefense.com. You've been listening to Law You Should Know on 90.3 WHPC, the voice of Nassau Community College. If you missed any portion of this show and you want to hear it again or tell someone else about it, just go to nccradio.org. And please join us next week at this same time for another program on Law You Should Know.